So basically, as just to give a simple example, what a moat is it's a barrier to entry for a business, right? So in the olden days, how Buffett used to term it is that you had a castle and then you had a river bed around it. So it wasn't that simple for anybody to just enter. So it's simple. So then from that angle, when you have a business and it can't just be replicated over time, so that's what a moat would be. On one hand, you have businesses that are generating high return on capital and high cash flows over a period of time. On the other hand, you have businesses that are at the mercy of the competitors. So what I mean by that is that you had a good ROEs, return on equities for a certain period of time, and after which they start deteriorating because of competition. And once that happens, then your multiples and start to deteriorate as well, and then that's where the investor could lose the capital. So that is the difference between investing with a moat and a non-moat. Of course, money can be made in both, but as we start looking in non-moats, it becomes a bit more tedious and a bit more difficult because their discipline that is required, the timeliness, and mainly the information edge. So basically, when you're playing with too many variables, the chances keep getting grimmer. In case of moat companies, over a period of time, they systematically get mispriced. So at Multi-Act, we believe that if you focus on this universe, the chances get highly in your favor. So the process that we use at Multi-Act, from a number point of view, I'm looking at return ratios, such as return on equity, return on capital employed, free cash generation. Historically, over say 5 to 10 years at the minimum, what you tend to realize is that when your return on equity is above the cost of capital for a particular country, and in India, say it's 14%, if that has stayed above that number for a particular time frame, that's the starting point. But it doesn't stop there, because then the point being that you want to identify that, okay, is this sustainable or not? So once we've identified, okay, look, this is an interesting candidate, then we start asking questions that, okay, whether this fits in to the 4 different types of moat categories that we believe. So first is the network effect. Then you have the switching cost, economies of scale, and intangibles. Let's take network effect. One simple example that an Indian consumer can relate to is Naukri.com. Now you have more employers on that platform. So when you have more employees automatically would post their resumes on that to get more eyeballs. When that happens, the unit cost for Naukri.com reduces. That gives him that extra edge of the higher ROE. This is one of the strongest moats. Even Visa and MasterCard would fit into that. Secondly, switching cost. That once you're used to and habituated to a certain taste or a practice, it becomes very difficult to change that unless there's been a drastic transformation. One good example will be the Colgate-Palmolive. So that again comes under the basket of stickiness, where once you get used to a particular product and taste, then it becomes very difficult to change. Coming to economies of scale. So there, good examples would be that Hindustan Unilever and a Maruti, where you have been around for a longer period of time, and because of which you have a higher market share. And once the gap between you and number 2, number 3 is so huge, your cost per unit automatically reduces. So that's economies of scale. And lastly, it's intangibles. So intangibles would be technology, IP, R&D. So a good example in R&D would be the global pharma companies. So I've identified the moat. I've identified, okay, great, this is a great business. It's got a moat, but that's not enough. So the point being that then we get down to valuations. The way I would view it is that if you overpay, then you could land up not making money for a long period of time. The good example is Colgate, where in 1995, if you would have invested where the valuations were high and competition has started to enter, for the next 15 years, you wouldn't have made money. So the point being that great Colgate is a great company, everybody is aware of it, but it's important what price you pay. That determines the potential returns that you will make. So as an investor, yes, it's important to keep evaluating that is there anything that is changing. So ideally, when we believe that, okay, look, the competition has become aggressive, are there any changes in terms of patterns, whether margins are getting eroded, whether ROEs are reducing. When we see certain signs on these parameters, that's where one should be looking towards and focusing on, because that's where you start identifying, okay, something seems to be changing here. So we also have a category known as emerging moats, which usually comes out in a bull market. So for example, in India in the last 2 years, a lot of eyes have been caught and a lot of upcoming companies which have shown decent return on equities over the last 2-3 years. What is important to understand that if this is sustainable, what the market extrapolates is that this is going to be sustained in the distant future, but they're not able to identify what the moat is. A good example would be the Indian ceramic tile sector, where there seems to be an illusion of moat, but we at Multi-Act believe there is no moat out there. We've tried to identify the source, but it's not that simple. And we believe that due to heavy competition, the return on equity in the future could come down. The valuations that the markets are ascribing to this are similar to a moat business. That's where investors need to be a bit cautious. Otherwise, there could be a permanent loss of capital. For an investor, when he's really looking at the non-moat, for him, he has to keep focusing on the timeliness in terms of when he's buying it, and focus on the information edge, which is not a forte that everybody has. And hence, Multi-Act would recommend investors to focus on the moat basket.
So when you only focus on the size of the opportunity, you have to also understand that whether the company will be able to exploit that opportunity or not. When a business does not have any barrier to entry, what you should look at is whether there is capital flowing into the industry or out of the industry.
We don't work on a target price approach because we think that's an incomplete approach, because it only looks at one aspect. It doesn't allow an investor to look at or understand both its reward and its risk.